we're about to do an entire quarterly market report where you don't hear the two words come out of my mouth that start with, that are abbreviated AI. So I didn't think I was ever going to get through one of those, but I don't even think it's going to come up. As you can see from the headlines here, we're going to replace some of that conversation with conversation about tariffs, which we'll get into in particular near the end. There's actually going to be three parts to the presentation today. We're going to start with a reminder of the market strategy and the key themes that we'll be talking about throughout 2025. So just a quick review there and how that related to what we saw in Q1. Then we're going to do a market recap, and the headline there is tech tanked and the dollar dropped. And there's a lot of implications that came out of that. I was a little worried when we were starting this series of presentations and using data that went through just the end of March, because the market had moved so much since then. But for those that have been watching every day, you won't be surprised to know that the big sell-off at the beginning of April was completely reversed by the end of April, and things came back up. So the data that you're going to be looking at today that goes to the end of March is more or less accurate through even where we are today. We're going to wrap up with the market outlook. We're going to do a bit of a deep dive into tariffs, although if we wanted to truly explore every aspect of what's happened in the past and happening right now with tariffs, we might need 5 or 6 hours to get through that. So we're going to shorten that to about 15 minutes and just cover the most important stuff. Still, hopefully go through a few details that maybe you were not already aware of. So let's kick things off and start with a review of our key themes for 2025. Definitely, it's a time for risk in the markets that's different from what we've seen before. The first key theme is going to be the one that's most relevant to what we observed in the markets in Q1, the idea of we needed to brace for a tech or possibly crypto crash in the markets. But just while we're on the slide, we'll mention that we do think 2025 is a good year to get more diversified. And in many cases, that's going to be diversifying out of public markets and into private markets. Maybe private credit is the part of private markets that many of our longtime clients don't have as much exposure to as their financial plan might call for, but we have the tools to remedy that now. We do think that financial planning is critical. I've seen many financial plans over the years, and I'm reminded of the ones I was developing in the early 2000s before the Great Recession, where a number of investors were taking on more risk than they really needed to take on. They were going to be perfectly able to meet their financial planning goals and all their spending needs by taking less risk, and happily was able to help a lot of clients get that risk dialed into only what was needed before the big sell-off in the markets. Lastly, just a quick reminder that safer assets can still be productive. Treasury yields are still a little bit higher than we might expect them to be, given market conditions and things that are going on. Maybe the Fed should drop rates just a little bit more this year, but we can invest very safely in treasuries, which means we're not too worried about FDIC limits and other things like that when your money is in a bank, and still comfortably beat inflation. And for most of my career, that's not something we could do. So that's a great opportunity to be safe and still be productive. Now let's go to this next slide here and just sort of make a point. If you saw our annual market report, you will remember that we spent quite a bit of time talking about the valuation of the overall U.S. stock market. The top 10 stocks, and you'll see it's really 9 here. Alphabet is listed twice because there's 2 different share classes for what many people still call Google. But that was about a third of the S&P 500, so a bit scary that even indexing couldn't insulate you from these stocks. But we're really worried about the valuations of these large tech stocks in particular. And so I had a number of slides that included this one showing the forward-looking price-earnings ratio, meaning where we thought earnings would be a year later in the current price, and just how expensive they were by historical norms. And what you see now is a column that I've added. The actual return of those 10 stocks in the first quarter of 2025, including with any dividends. And so it turned out that our concern about tech stocks was warranted. Our concern about the largest stocks in the market in the U.S. was warranted. And 9 of those 10 dropped to negative returns. 8 of those 10 pretty alarmingly so. Certainly when you see some stocks that are down 20 or 30%, it's concerning, but we hope that our investors that may have had a bit extra in one of these stocks, maybe with us or maybe outside of us, had given us the opportunity to deal with some of that before the big sell-off. So we'll come back later in the year and review our other 3 key themes, but that certainly was a good key theme to have coming into the year and to get in front of this big sell-off. Now let's take a minute and review some of the other things that happened in the market. The headline is, again, tech tanked and dollar dropped. And the first slide we're going to get into is about currencies, commodities, and countries, and we'll kind of make the point here in a more detailed way. What I'm showing you on this slide is the relative change in the value of different currencies, and that's the US dollar there at the bottom, a pretty significant fall off in the value of the dollar relative to other countries. And the way currency valuations work is if our dollar fell, that means, at least for US-based investors, other currencies appreciated. And that sounds pretty negative, and it could be a negative, but just so folks know, there is always assumed by professional investors and economists to be a secret war going on between all of the major economies attempting to devalue their own currency, at least a little bit, because of the effect that it has on exports. When your currency is cheaper, you can export your goods abroad because your goods become a bit cheaper on the world stage. Now, no country would typically want its currency to devalue quite this much. That starts to suggest some other problems, such as confidence in the country, confidence in the currency, that could have some bad effects downstream. But a devaluing currency is not necessarily bad, again, because of what it does for exports coming out of that country. But it's a big part of the story of what we have seen so far this year, and certainly in Q1. One of the side effects of a devalued dollar is that it is inflationary. We typically see this first in the price of commodities. And as we list here, the several dozen largest commodities that are purchased on the world market, most of them became more expensive for Americans. Some of the industrial inputs, such as copper, some of the commodities that we consume, such as coffee, soybean oil, beef, sugar, things like that, definitely got more expensive. There's a number of indexes that attempt to wrap all this up, and we've quoted here the return of the Bloomberg Commodity Total Return Index at being up 8.88% for the quarter. And so these types of physical goods, these commodities, are an input to production for all sorts of goods that Americans consume. And this is a sign of those rising costs and usually a higher rate of inflation down the road. Again, this is a direct effect of a weakening dollar, and now it takes more dollars to buy these commodities. And lastly, we're going to end up here with a slide about country returns. And so the U.S. didn't do all that great in Q1. We're showing a lot of different economies or markets across the investing landscape. Just to give a perspective, what you'll notice there in the red bar is the total U.S. market. The blue bar, a couple to the left of that, is the global equity index if it's weighted by what we call market cap, by size of markets. Of course, the U.S. is a big part of the global market. But what you see is that most countries' markets, from the perspective of a dollar-based investor, did pretty well. So you'll notice that Poland is at the top. Now, I do want to make a kind of a technical comment here. If you're investing in Poland, you didn't see those kinds of returns. Again, this is from the perspective of a dollar-based investor. And so we got whatever those markets got, but then that is multiplied by the effect of the currency. And so when the dollar falls, again, other currencies rose. And so when we invest abroad in stock markets, we get what the markets did, and then we get the currency effect laid on top of that. So again, this was largely driven by a falling US dollar, but certainly a reminder that being diversified across the globe will at times help quite a bit to mitigate your volatility. And then there we see our benchmark numbers for the first quarter. And if you look to the bottom row, despite all the bad news that I just shared with you, if you were globally diversified by, again, what's called market cap, what you see is that the global equity index was only down 1.61%. As you'll see in a few more slides in a moment, our value tilt also helped. So many of our investors were flat or maybe even slightly positive for the quarter with their equity exposure because of how that diversification away from U.S. large tech names helped so much. The rally in fixed income that you see in the top row was a function of interest rates falling. And despite all the headlines that you might have seen, the world net was flocking to treasuries. And so the yield curve fell. The government was able to sell treasuries at a lower interest rate than before. And so the fixed income index rallies from a price standpoint. When interest rates fall, it makes any bond exposure that you've already locked in all the more valuable when the going rate for new issuance is at a lower rate. So we saw the fixed income be a good diversifier to the equities markets. And for most of our investors, their returns ended up being relatively flat, or again, maybe slightly positive, even for the folks that owned more equity than fixed income because of how we invest in equity. So not quite the tragedy that some of the earlier slides might have led you to believe. And as we go out to longer periods of time, 5 years and 10 years, we start to see returns now in the rearview mirror that are a little bit closer, certainly for the 10-year, to what we're going to expect to see going forward from here. Breaking things down just a little bit more, getting more granular. Again, what you'll see is that the U.S. stock market in isolation fell more than the global equity index, but these other parts of the market, international developed stocks, emerging market stocks, had a bit of a rally for U.S.-based investors. And again, the U.S. fixed income index did pretty well. So kind of interesting that the global bond market was down a bit, even with the U.S. dollar falling, suggesting some stress in some of those markets. And if you really dig into the headlines, you won't be completely surprised that some of the bond markets around the globe are experiencing a little bit of stress, again, as assets left them generally and flocked to U.S. Treasuries. Within the U.S., there's a pretty interesting story to tell. Now, there's a lot of data on this page, but maybe what I can focus you on is the table at the bottom. It is depicting what you also see at the top, but the best place in the U.S. market to be an investor in Q1 was in large cap value. That's very different from the growthier parts of the market. So at BIP Wealth, we overweight value, and that's one of the reasons that for our investors, they might have done a bit better than that global equity index even would suggest. It's not just that you had some of your investments overseas, but we have a value tilt, and that helped a bit since the large cap value index was actually positive for the quarter. Within international developed market stocks, it's very much the same story about our value tilt doing a whole lot better than a growth tilt would have. So there was actually a value rally, you might say. Now, the home market returns in aggregate were between 6 and 7% overseas, but it's when you add in the currency effect that number jumps up to the 10% plus that you see. So we show that in native currency, and then we show that in dollar for dollar-based investors with the two different bars that we depict in the top right. So that's why I'm calling it a value rally. in the first quarter. And again, a reason that our investors maybe didn't see losses at all, but in fact enjoyed a few gains. It's just that same story again in emerging markets, but the currency effect is less pronounced in emerging markets. A number of countries that we lump into that category of emerging peg their currency to the US dollar. So a few don't, and you get a little bit of an advantage there in a quarter like this. It's just not nearly as pronounced. And yet, again, the trend was that value did way better than growth. And that's actually been a somewhat persistent theme, not just in most recent quarter, like in the US, but across 2, 5, and even 10 years, where value's been a pretty good place to concentrate. Lastly, in our recap, we want to talk about fixed income. And what we don't see in the Treasury yield curve is that there was a huge change from the prior quarter or the prior year, but just a little bit of a fall in interest rates causes the index to rally. If we start to get some bad inflation numbers and the yield curve starts to move up, we would see damage in the same way, meaning that the fixed income index would fall. And it's done that a number of times over the last few years. We continue to focus a great deal of our investing in fixed income into instruments that don't rise and fall with changing interest rates, because we can get a pretty nice low single digit yield with almost no volatility with floating rate Treasury instruments and various things like that with the shorter duration. We've been doing that for over 3 years, and certainly the 3-year numbers that you see outlined there in the green row have served our investors well. So if we suddenly see rising interest rates again, our investors will be pretty protected from that. We're really looking for stability with our fixed income strategies, not to have volatility that at times could come close to the same volatility that we see in the stock market. And now let's talk about our market outlook. The headline at the annual market report was about embracing uncertainty. And I hope that a lot of our investors were able to adopt that mindset. As Bill said, they'll look for chances to buy, which of course was the thing we were doing for clients, and except for a couple of cases where somebody asked us not to. But I've replaced the headline with tariff uncertainty in particular, and we're going to get into some of the details around that. There's lots of other things to be talking about, but this is certainly what's dominating the headlines. I checked those even before we started the webinar today, and sure enough, tariffs are what's taken up the headlines on all the financial media today. So let's just dive in here with how much and why now. And what I'm giving you here is a brief history of tariffs that goes back to the beginning of Trump's first term. And I'll just make a note that tariffs were running at about 1.4% average tariff on imports at the beginning of Trump's term. A lot of headlines, a lot of drama, a lot of stories going on. The USMCA replaced NAFTA. A lot of those tariffs went away. Not so much with India. They've retaliated. I'll show you details on that in a minute. And when Biden came into office in 2021, he kept the tariffs in place, generally speaking. They were up to about 3% on average against imports. Now, there have been a few headlines since then. Biden got rid of some, increased the tariffs on EVs and semiconductors coming out of China. But we did end up with a bit of an interesting data point, one that's probably not covered too much in the press. But if you look at the sum total of tariff revenue over the last two presidencies, it was actually higher under Biden than it was under Trump 1. So we're at around 2.5% at the beginning of the Trump's current term. We'll see where we end up, but we could have put up a couple hundred years of tariff history here if we wanted to. I just thought folks might appreciate a few of these more recent headlines and a couple of the data points that jumped out at me. One of those headlines that we had just reviewed was about India and them retaliating. And I came across this bit of data about what we're calling the tariff differential, which is essentially the average tariff rate on the net exports that each country gets from us. And what you see, that's a complicated formula, but just suffice it to say that India is the real offender these days. Thailand is next. Argentina is next. When India retaliated against us a few years ago, being unsatisfied with our stance on tariffs, they became the country that on a net basis imposes the most restrictive tariffs. So generally speaking, it would be the hardest for the U.S. to export its goods to India. Relatively easy for India to send things to the U.S. market, relatively harder for the U.S. to send things to the Indian market, and by far the worst offender, which again, you see Thailand, Argentina, Indonesia, and other countries there as well. China is pretty far down the list, kind of in the middle of the pack in terms of the rate of tariffs. But of course, we have a much larger volume of trade with China. And so if we look at the next chart, I did just want to share this. And this was something that I've alluded to more times than I can count in prior quarterly market reports when someone brings up the question about our national debt. And in fact, when we were delivering those 14 annual market reports where I didn't focus on the size of our national debt, we usually ended up with a question at the end where an audience member said, hey, can you just talk about the national debt for a minute? So that's one of the reasons why tariffs are in the news right now, is because tariffs are seen as a way to close the annual budget deficit to a sustainable number so we can begin to hopefully chip away at the size of our national debt. But what I put up here in this slide is a tool where you can attempt to solve those problems yourself. This is something that's provided by a group called the Committee for a Responsible Federal Budget. Now, the Committee for a Responsible Federal Budget is not a group of elected officials. Many of these were politicians and elected officials at some point in the past, but as former politicians and economists and folks that really are concerned about the size of our budget deficit and the ever-growing national debt that results from that. And so they've got one of the better calculators out there. And so you can go in and model how you would attempt to fix this problem. This one is framed around the topic of the day, which is that the tax cuts that came about during the first Trump administration are set to expire at the end of 2025. And, generally speaking, there's a couple ways to deal with this. One is you just let them all expire, which would mean that tax rates would go up. Now, when these budget deals get passed, there are some rules that Congress and the White House have to obey. And so one way to kind of get around those is to, for instance, propose a bunch of tax cuts that will sunset, that will go away. So then tax revenue is projected to go back up in the future. And of course, that's happened numerous times, and that's what happened this time. And so maybe they go away and maybe they don't. What you'll see there in red is this number, $5.2 trillion. If we were to extend all of the tax cuts, and this website, this modeler lets you go through these selectively, that's how much of a revenue loss we would get over the next 10 years. Or if we just let all the tax rates go back up, it's going to add $5.2 trillion to revenue collection by the U.S. government. And of course, that would go a long way towards reducing the size of the budget deficit. What's also kind of interesting about this particular tool is that when you go in and attempt to solve all these problems yourself and balance the budget, you can email your solutions to your representative so that they can see what you came up with. I'll give you a little secret here. It's pretty hard to come in and actually solve the problem, even with all the tools available to you. And so that might give you a hint, if you play with this yourself, just what a struggle our elected officials are up against. So if we do end up with extending the tax cuts, some or all of them, we are going to end up in a situation where collecting a lot less revenue than was proposed in the way this set of laws went through the Congress and the White House just a few years back. As part of that, just to keep in mind here, there's what's happening from a tax standpoint, but then what's going to happen from a spending tax point. And when you put those two things together, that's what we call fiscal policy. There's the tax side, there's the spend side. And a number of proposals have been coming out. Nothing has been put into law just yet. But it might not be a surprise if you follow the headlines that an increase in defense spending is at the top of the list. Homeland security, not far behind that. And then there's a number of big cuts that have been proposed. Some of that is a part of efforts by the so-called Doge group, as well as things coming out of various congressional representatives as well. So if you look at the net of what's been proposed so far, it's actually a pretty significant spending increase. So we might be looking at tax cuts. We'll have to see. What we do know is that so far the proposed spending side of this is to significantly increase what we're spending, primarily with what's going to the Defense Department. And then here's the slide that kind of, I think, more correctly states what the current administration is focusing on than just the fact that India is imposing the biggest tariffs on U.S. exports. What this is showing you here is the trade deficit or surplus. For instance, at the bottom, we do have a trade surplus with the UK. We have a trade surplus with Australia. That might be a surprise to some folks, but yes, there are some countries where we send more to them than they send to us. But of course, at the top of the list is China, and that's the country with which we have by far the biggest trade deficit. Now, this is a really important but highly technical detail. Many people that have looked at tariff policy in the past would have focused on Indonesia and those other countries because their tariff rate relative to ours was the biggest. And that's seen again as kind of punitive. And the reason for that focus is that for many economists, a trade deficit is not an inherently bad thing. For many of us, wherever we're sitting today, if we look around the room we're in, we look at the computer screen that we're watching this on, we look at any other electronic equipment, maybe the chair we're sitting in, the furniture in the room, what you'll quickly realize is a lot of that was made in China. And you and the various businesses you procure these items from quite willingly, voluntarily chose to do business with China because it was a good deal for you. It made those goods cheaper. You that had money left over to buy other things or to invest that money. So I'm a admitted capitalist, and part of the principle of capitalism is that two parties engaging in trade willingly both benefit when they trade. One party spends money, the other party gives up goods that it's produced, but it's in the interest of both. And so generally when we have a big trade deficit, it's because one country has a competitive advantage. They can just produce things more cheaply, for instance. However, the current focus of policy from the administration appears to be targeting the trade deficit as opposed to the tariff rate per se. And so we're not entirely sure how steep tariffs would have to be to not run a trade deficit with China, but essentially it would have to neutralize the cost advantage. And if you were to tariff enough to neutralize the cost advantage of producing goods in China, that would be very inflationary. So we'll see where we end up. The reason that I wanted to point this out is because there are folks in the administration outside of it that have as the ultimate goal free trade policy. Let's establish free trade between the U.S. and other countries, but free trade is not going to get rid of trade deficits. And if you get rid of trade deficits, you don't have revenue to offset the budget deficit. So we got to figure out exactly what the goals are. If it's to get rid of the budget deficit, we're going to probably end up with some inflationary policies. If it's to equalize tariff policy, then it would be focusing more on India and some other countries. If it's to get rid of the trade deficit, then you can understand again why the focus is on China but we really got to be ready for some rising inflation numbers if we do that. So we don't know where the end game is going to take us yet. There's a lot that's being negotiated, and again, the markets have more or less recovered from the downturn of April, but we know we are not at the end point yet, and we're watching the headlines just like you to see where this ends up. So a couple of other data points that I wanted to bring to folks' attention. One here is that we can separate our trade to be between services and goods. And a lot of the conversation is about goods. Commodities affect goods. And indeed, we're running a pretty big trade deficit when it comes to goods. That's the lighter blue part of this chart. But when it comes to services, financial services, legal services, business consulting, movies, for instance, we run a pretty significant trade surplus. This is relevant for a couple of reasons. One is that the total trade imbalance is less than it would be if we were just talking about goods. Still very much a trade deficit, but mitigated by that. The other is that one of the most recent items in the news is the idea of 100% tariffs on foreign movies coming into the U.S., and that is, in fact, part of the services sector. And so we already run a pretty good surplus there. If that tariff is mirrored by other countries, that could actually hurt one of the areas where we're running a pretty good surplus. You know, Hollywood, U.S. Media productions, movies in particular, are exported all over the world. So it's a very complicated subject to look at, but I just don't think everybody that's hearing what's being said these days is aware of how successful we are in exporting our services. Another interesting piece of data that lies purely in the goods category is what's happened in the U.S. with regard to energy. Now we're lumping oil and natural gas, other forms of carbon-based energy into this. Certainly liquid natural gas is come on big in the last few years, but if you look at the orange line, that's our energy exports. What you've seen is really going back to the last Bush administration, that began to rise. And that continued right through the Obama administration, through Trump's first administration, through Biden, and even today. The U.S. is a net energy exporter. As our exports have risen, our imports have fallen. And the net of those two for the last half decade now has been that the U.S. is a net energy exporter. And so the drill, baby, drill motto rings as perhaps a highly politicized statement, but we have been bringing more energy out of the ground, if you will, for quite some time, really for a couple of decades through Democratic and Republican administrations. And when it comes to just that sector, we are a net exporter now. Now, to be clear, there is a lot of carbon-based energy that we import. Our oil refineries, for instance, are only set up to deal with certain types. So we are an importer and an exporter, but the net of it all is that we're an exporter. Again, one of those, I think, sometimes hidden stories that you might not be aware of if you're just looking at the headlines. So as we're beginning to wrap things up, I'll remind folks, we sent this out in an email update a few weeks ago. I think there's 4 ways to think about the headlines that we're reading every day. And this is certainly the way I analyze them. The first one is I'm reminding myself that whether stated explicitly or just implied, a lot of folks believe that the current Trump administration has made a promise to be focused more on Main Street than Wall Street. And in fact, I think that some of the tariff policy that's been announced bothered some folks on Wall Street, and many of the articles that you may read in the press, regardless of whether it's a more progressive or conservative leaning outlet, are authored by people on Wall Street, by firms on Wall Street that create these content and market them out to news organizations to run. So there's a bit of a propaganda war going on with Wall Street creating a lot of content and analysis, sometimes I think a bit overblown, sometimes not so much. But that's a filter just to have, is that Wall Street's not particularly happy right now when they're letting it be known, but you might be reading their opinions in ways that you're not aware of. The second thing is this retaliation versus negotiation theme. And of course, we've seen in the last few days that it looks like the US and the UK are going to negotiate as opposed to what's happening with China, where it appears that they're ready to retaliate. And I think a lot of folks in the administration look to turn retaliation to negotiation. What we said from the beginning of this is that it's possible that after the first deal or two gets announced and the details are known, that other countries begin to understand what the Trump administration is going to interpret as a good deal. And so perhaps the dominoes begin to fall. We don't yet know if that's going to be us seeing free trade agreements or simply lower tariffs. But I think that every time you read something in the news, just think, is this about retaliation or is this about negotiation? And as it moves more and more towards negotiation, which it could do, probably the economy and the markets and everything will move in more the positive direction. Let's also not forget about Federal Reserve rate policy. The Trump administration has been vocal and demanding that interest rates be lowered. I've actually been calling for that for about 6 to 9 months, because I think that the overnight interest rate is still a little bit restrictive. However, the Federal Reserve, while trying to ensure full employment, is very definitely on the watch for inflation. And if we get some bad inflation news because of tariffs, they will not be able to lower interest rates without triggering ever increasing inflation. And they got into trouble with that a few years ago when they had rates too low for too long, and we were seeing inflation prints in the 9% range. So I think the Federal Reserve is a bit handicapped right now. They used to own, we thought, what was known as the Federal Reserve put, and that's options lingo referring to the fact that the Federal Reserve could juice the economy, juice the markets anytime it wanted to by lowering interest rates. But they can't do that anymore if there are signs of growing inflation, right? So now the Federal Reserve doesn't own that option in the way that they might otherwise because of the risks of inflation. However, now what you might read about is what's being called the Trump put. And the Trump put is the ability to roll back tariffs to negotiate a de-escalation of this potential trade war, and in doing so, allow the markets to recover, allow the economy to recover, allow inflation, expected inflation to fall. So what had been power in the hands of the Federal Reserve is now power in the hands of the administration. And again, that's often being referred to as the Trump put. Lastly, we've got electoral patience in here. A lot of different opinions out there, but for the most part, we've not seen real problems. Of course, there's news items out there about ships stacking up in ports and potential inflation coming our way. And if we start to see those real effects, it's anybody's call as to when patience will run out or how long it might just last. So, that's a political call that we're certainly not prepared to make. But again, I think these are the four forces that are at play out there. And it's always very helpful for me to have that in front of me whenever I'm reading the news items of the day. It's just a great way to interpret what's going on. So let's go ahead and just wrap up. So tariff policy is complicated. There is just a lot going on. Tariff negotiations often take years. It's no surprise that Trump didn't get this done in the first 100 days, and it won't be a surprise if he doesn't get it wrapped up in the next 100 days. There's just a lot going on. So be prepared for timelines to be extended. Secondly, the U.S. economy at this point is still quite strong. And despite some headlines that do not believe that we are in a recession right now, I think, again, there's the headlines of that nature are serving somebody else's agenda. And lastly, we rolled out our key themes for 2025 in a way to offer hope to people, whether it's the idea that you could significantly reduce the risk in your investment strategy and still meet your financial planning goals, or maybe there's an opportunity to become more diversified, maybe using some of our investment strategies that you haven't tried before. When each of you is talking to your personal wealth advisor, I hope that you'll be open-minded about the fact that your advisor has a pretty big toolkit, a large number of strategies that create different effects on how your portfolio behaves. It may be that you've never done much in private investments, and that's what you potentially could benefit more from. It might be that private credit in particular is something where you could enjoy some higher yields than we could ever hope to get out of the public markets. And that's what you need. Everybody is different. We certainly have a number of clients that have done a lot in private markets over the years, and maybe they just need to build up their exposure to our treasury strategy, what we call short-term tactical, if they're living out of their portfolio, to make sure that they've got the next few years of cash flows in the safest possible investment category. Again, we have a pretty big toolkit. There's a lot of things we can do. So I hope you'll be flexible when you're talking to your advisor and give them the opportunity to do everything that BIP Wealth can do for you.